Wednesday on Zoom. Thank you for making the transition with us and moving over to a new platform. This is a new experience for us, so if there are tiny glitches along the way, please just bear with us, but we are very excited to have you with us here this afternoon, and we look forward to sharing with you. I'm joined today by a few of our team members and colleagues. So we've got Scott, Fritz, Alex, and Siska on the line. At the moment, I think we're going to be joined by Gavin and Lyndon as well in a little bit. So I'll hand over to Scott to say hi.
Awesome. Thank you very much, Lee. So we are super excited. Welcome. You are all the first on our first Zoom webinar. And so that it's quite a, it's quite an interesting thing because you have to sort of stay with the times. And I've been running webinars on GoToWebinar for 12 years. I did my first webinar with them back in 2008. And so it's quite a big thing for me to move away, but I can safely say that it was no longer the best system out there. And we want to always be enhancing and providing the best solution. So I want to quickly share my screen. Luckily for us, it might be the first Zoom webinar, but we do, as I'm sure most of you, use this once or twice a day. So let's rock and roll here. We really want to welcome you back to the WealthE Wednesday. It's the 1st of July. I woke up this morning, I don't know if I speak for everyone else, but it sort of dawned on me that it was the 1st of July and I was now in the second half of the year. And that's quite a scary thought when you consider that most of us have experienced tremendous disruption in 2020. I often did a whole bunch of presentations in the last 3 months of last year saying, are you ready for 2020? And I don't think many of us were. And so, I had a bit of a reality check this morning and it was like, wow, we're halfway through the year. And so the purpose of these two webinars that we're going to be doing, the first one today is the practical session. And to remind everyone that what we do on WealthE Wednesday is that the lunchtime session is all about practical. So it's talking to the team, it's understanding what's happening with the platform, due diligence. If you've got to ask any questions you want, anything you want to know about the deals. We are going to be talking today about market cycles as well, because some quite significant things have been taking place in terms of market cycles going forward and what you can expect. And then, we're in this environment and it's so interesting because what's happening with COVID is it's just forcing, whether people like it or not, into Wealth 5.0. We're not going to talk about it today in terms of the whole principles. We have had the ability on WealthE Wednesday for people to get involved in the starter pack. I'm not going to talk about that, but if people are interested, they can type in their starter pack and reach out to Lee. But the real thing and the real purpose of today is to talk about the deals. Talk about what deals we have, what deals we've done, what deals we're doing. Also to talk about the wallets and KYC and anything that anyone wants to talk about with regards to that and updating. And then just as a sneak preview, tonight, Lee very kindly asked me to open up my life and to share with you my progress for the last 6 months. And so I'm going to look at my year and review my year. The analogy is that any successful person not only sets a goal, but also tracks their progress on that goal. So the metaphor I like to use, or the one I was given years ago, is that if an airplane takes off from Sydney to London, and if they don't track their progress on a, literally minute by minute basis, if they start going 1 degree off, they can literally end up in Berlin. And so the question for you is, what systems do you have in place? What are you doing to hold yourself, on track? And then really the last part of today, which is critically important for me, is that we've got our wealth partners, our wealth consultants involved. Fritz and Alex are online and here today to be able to answer questions. They're also here to represent the voice of the investor, because they are the ones that are helping clients on a daily basis, sign up, KYC, get their wallets funded, understand the deals. And so sometimes clients can't make it. They can be here to ask questions, and really give us their input. As I tend to say, they're the tipping edge of the sword. They're at the front lines along with Siska who's also here from a customer services perspective to be able to answer any questions. So this is very much a customer-facing webinar and really around you being able to get practical. So Lee, that was all of my side from a setup. What I'd like to do, if unless anyone else wants to take the lead, I see Lyndon has not been able to join us yet. So what I'd suggest we do is that we just get people's inputs in terms of the 5 people that we got online. Any of their inputs from the month that they think are relevant around this practicality. And what I'd like to do is I'm just going to go sort of top to bottom as I see it. And then I'll bring up the platform and I'll actually log into the platform and we can start to look at the deals and more importantly, we can start to then talk about cycles and everything in that space. So what I'd like to do, Fritz, if you don't mind, if I start with yourself, and is there anything that you believe from an investor perspective that you believe is relevant that has come about in the last month that they should be aware of? And by the way, for all the guests, I am putting our team of panel on the spot here. They have not come prepared with this.
Oh, thanks, Scott, for that quick introduction there. For those of you who don't know me yet, as Scott said, my name is Fritz, and I do represent the investor side. I'm shoulder to shoulder with the investors. I'm more on your side than I am on Scott's side. But in any case, so Scott, in terms of the most pressing thing that I feel we can discuss today, or we might flesh out on, is if we go onto the platform now, we do see, and I believe it is something we want to discuss. We do see that there is a sort of a small variety to choose from at the moment. I'm sure that we can talk about that a bit more, but in terms of the, we had our webinar with James Painter a while back, and his outlooks on where the dollar is going relative to the largest trading partners. That's a major sort of point for a lot of the investors in terms of where they want to invest next, where they want exposure. Do they have exposure in the US, or do they have exposure do they want exposure in the EU or the UK, for instance? Now, myself, I've been trained as a fundamental sort of analyst. I studied investment management at Tux, and it's all about fundamentals for me. That's my space, and that's where I feel comfortable. So, James, for those of you who are on our inner circle, you might know James, but he uses technical analysis to forecast basically what the currencies are going to do and what the economies are going to do. And I actually read an article. I've been doing quite a lot of research on the fundamental side of that outlook and how that sort of fits together with what James is saying. And it's actually quite interesting, the contradictions there in terms of, fundamentals. I got the most recent article from Anchor Capital, where they basically went into the fundamentals. They went into the stimulus that America, for instance, the US now implemented, and people generally think that, sure, well, they went down a credit rating bracket by boosting their own economy, trying to spend their way out of a economic sort of downturn. And I mean, if you look at it now, it seems like there's a bit of a bull market going on at the moment. But it's interesting to see that the fundamentalists actually believe that relative to the US's, relative to the economy size, that the stimulus actually isn't such a big thing, and that the economy, the US economy, continues to be, according to them, continues to be a good place to invest. So I know on the supply side, we've been pivoting towards a bit more EU exposure for our investors, giving them the opportunity. And that, of course, we've got the intercare opportunities in the UK, which our investors love. And I do believe we've got some more EU opportunities coming. So that's also exciting. I think that's the most relevant thing for me at this point in time.
Awesome. Thank you very much, Fritz. Alex, from your perspective.
Thanks, Scott. Yeah, thanks for the intro, Scott. I think the thing that is most relevant to what I've seen the last few weeks from investors is that they're unsure of what's happening at the moment. They definitely are keen to go into the European space and get exposure there. Most of the investors are already exposed in US, and it's all of the name of the game, as we all know, is diversification. So mainly is going into that space and understanding that space a little bit more in detail. So yeah, that's information I've received last.
Thank you. Cisco.
Hi, everyone. I am reporting from Cape Town. It's a beautiful day out here, so only positive vibes from my side. From a client perspective, the feedback that I'm getting lately is a bit of confusion as to why people have to KYC their profiles again. And obviously, I'm happy to explain that a little bit later in our webinar. But in general, our client services team are quite good in getting good turnaround times back to our investors to get them verified by our new wallet service provider. So all good on my side. Thanks, Scott.
Brilliant. Thank you very much. And just, Cisco, can you also, should we good now? No, we'll come back to answering Ken's question around the KYC. Sure. KYC, etc. Sure. Gavin, if you go, and then we'll finish with Lyndon, because we'll pivot straight into the deals and where we're at and where we're going.
Yeah, perfect. Thanks, Scott. So not a huge amount that you can see on the platform right now, which is always very interesting, but that's specifically what Lyndon and Scott are here to chat about today. So we'll dive into that. Outside of that, making sure everything is up and running and stable. And we've had, on a purely tech perspective, the last couple of weeks has been fantastic. I think we don't have, on a tech, you normally aim for 5 nines uptime, which is 99.99999%. At the moment, we don't have that. We've got a 1 and 2 zeros. So that's always nice to have that.
Perfect. Lyndon, from your side, do you want to, I don't know if you want me to stop sharing and you can take over, because my understanding today was that we were going to talk about some of the deals that were on the platform, and more importantly, how the market cycles are changing and how we see that evolving and how we want to get involved. So do you want me to share my screen with you, or do you want to just run off my screen? How do you want to do it?
Yeah, I think let's keep your screen up. I think it's, I think what most people will see in terms of what's on at the moment is a single deal that's open for funding and only for South African investors. And that should get us asking questions as to why that is. And I think, Scott, what's worth having a note is if we go, I'm not sure if it's on the marketplace, but probably, tell a few different stories about where we are in the market cycle right now, because it has significantly changed in the last 3 months. And what the impact is for investors, where the opportunities are going to come, and what the timelines of those opportunities are. That's very much at the heart of the marketplace and where we're at. So I think probably the best deal to talk about is a historic one that was on there a month ago, was on there 2 months ago, and is no longer on there today. And that many of our investors might have invested in, because I think it creates a good example, and that's Medical 27. So Medical 27 was brought to us by one of our sponsors, Obvest. It was a deal where, like most commercial real estate deals, it went through the full suite of the commercial real estate deals cycle. The company, Obvest, did their due diligence and started that process about 3 months ago. They found a good deal. It was a very exciting deal. I remember when it was launched, there was a lot of excitement from investors as well as from the WealthE Investment Committee about this deal. And the process that they go through is they sign an agreement with the seller of that particular real estate asset saying, here's the price we've agreed on, and we will have 60 days to do further due diligence and to raise funds. At the end of that 60 days, they sign a final agreement, which is called going hard. And at that point, they are committed. They cannot pull out of the deal without there being penalties for them as the buyer for pulling out. So what happened during that 60 days is COVID hit. And as a result of that, the price of real estate across the board dropped. And while it did not drop in the medical sector as much as it dropped in other sectors, the WealthE Investment Committee said and had a look at it, and the price of this deal has probably dropped about 10% if they had to go and buy that asset in the new environment. So therefore, as their 60 days came to an end, they said to the buyer that they would no longer purchase the building and pulled out of the deal. All funds were returned to investors. And I think that's a great story to start our conversation about cycles, is because where we're at right now is very much a point where the real estate sector is resetting prices on deals. Some markets are significantly hit, others are less hit. Some are actually doing well. So if we think about it, if you currently own a retail mall or a strip of shops, a building, you're in trouble because those kind of real estate assets are under enormous pressure. And I think a lot of the retail behavior from people wanting to go shop has changed significantly. And those buildings will probably be in less demand for quite a while to come, certainly not just this year. However, if you had invested in a building that was, for example, a logistics store for Amazon, you're smiling, and those kind of warehouse and logistic operational buildings, their cycle is going to be on the up because that kind of building is coming in for more demand. Overall, though, and Scott, I think I'll pivot to you maybe because I think you're a longer-term real estate specialist than I am. But overall, we are in a cycle where in terms of real estate buildings, we are going to enter into a time where we are getting more deals from distressed assets coming through and conventional deals at normal prices. If you have a building right now that's paying you a good return, you are not going to put it out on the market because those are hard to come by. So a lot of the deals that are going to come onto the market now are those that are struggling, and where a opportunistic developer, an opportunistic sponsor will come in and see an opportunity to get that building at a low price and then either change its usage, or because they've got it at a low price, they can still operate it in a way that makes money. And that's really the stage of the cycle we're in. But maybe, Scott, you want to just take over that conversation around the general cycle and add to it.
Yeah, so I think it's quite relevant in that. Where's my mouse gone? There it is. So just to confirm, I presume you can all see my screen that says sponsor, huh?
Correct.
So I did some research in preparation for this. The first thing I thought was very interesting is that last month, thanks to Alex, we had Francis Veruli on this webinar, or actually the evening session. And if you didn't listen to it, I highly recommend you go and listen to it. So if you want it, just put in there, June recording, June recording. And it's really interesting because the old adage around property is cycles and trends and everything that Lyndon's talking about. And Francis Veruli, Professor Francis Veruli, is probably one of the most respected people in the South African property market. There's always 3 or 4 of them per country that are the main people and are known as the kind of the nutty professors in terms of it. And we've all been taught in property, it's location, location, location. And what's interesting is in the last month, he's come out and said, it's not about location, location, location. It's about technology, 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 and data, data, data. Okay, so this is really, really important. He also talks about steep and the principles of STEEP and what are involved in STEEP. And again, I highly recommend that he talks about where the world's going with social trends, technology trends, environmental trends, economic trends and environmental trends and political trends. Okay, so when you're talking trends and cycles, what's quite interesting here is we've got the property clock, and I'm going to go to that now, and then we've got long-term macro trends that are changing and quite frankly being accelerated by Corona. Okay, so I will put this article in the chat box so that everyone's got it. So I've done that for you. The second article I wanted to talk about was the property clock. So I want to just see, and I want some interaction from people. Who here has heard or seen the property clock before?
First time, Scott, surprisingly.
Anyone else? Interesting. So believe it or not, this has been around for a while. I'm going to show my age, but I did first year university in 1995, so 25 years ago. And Professor Francis Veruli taught me about the property clock in 1995. And this one happens to be the industrial property clock, but it doesn't matter because you've got an overall one for the property real estate industry. You've also got ones per country. So just to be clear, what's happening in Australia is not necessarily happening in Australia. What's happening in America, what's happening in England is not necessarily happening in South Africa, as an example. However, in any market, you can actually see here that you've got a falling market. Okay, so from 12 to 3 is a falling market where funding decreases. And then you've got a bottoming out market. Okay, so this is where there's virtually no construction and demand is falling. Okay, are you with me so far? And if you look down the bottom here, this is when you should be purchasing. Okay, so we've all heard the old adage, don't follow the crowd. When there's blood on the streets, there's opportunity, blah, blah, blah. Okay, then sentiment starts to change and we have a rising market. Demand increases, funding increases. What happens? Well, construction peaks and all the developers go out and they build loads of houses. Those of you in Cape Town, you might know what I'm talking about. And there's properties all over the place, commercial properties. You know, I was driving up the road of where my commercial offices used to be 12 years ago, and there's to let signs all up and down the road because they built a whole bunch of space. This was pre-corona. There was to let spaces. And then sentiment ducks, and we go back into this side of the property clock. So you can see here, seller market, purchaser market, and you can get more technical if you want to get into, you can have cap rate compression, cap rate expansion, etc. I'm not going to get detailed today unless people want me to. So equally, it's a tenant market. So whether it's residential or commercial, you know, right now, if I'm wanting to rent office space, you know, the world's my oyster. I can negotiate anything I want. I probably shouldn't say this because I hope my landlord's not listening, but with COVID, I decided to upgrade and to find a better house because the beautiful houses that were fully furnished, they were renting out permanently on Airbnb and making a hell of a lot of money. Well, I went to them and said, you can choose between naught revenue or you can get some revenue. Which one would you like? And so much more tenant power. And then obviously in this side of the fence, much more demand, less supply, landlord power, investor power. You see the other. So I've got a question for you. So this just happens to be the industrial property clock that he put, but with all due respect, the property clock is the property clock. Okay, so I've got a question for you. If we were to take the global property market, where would you say we are? Just you can type it in there and just type in the time. So are we at 1 o'clock? Are we at 10 o'clock? Are we at 7 o'clock? And by the way, Fritz, Alex, Gavin, Siska, Lyndon, you know, please jump in because this is what I wanted to reiterate when Lyndon talks cycles. I can see we've got 2 o'clock, 3 o'clock, 1 o'clock, 4 o'clock, 1 o'clock, 2 o'clock, around the 16th. Wow, we're thinking out the box there. 5 o'clock, 2 o'clock, 3 o'clock, 3 o'clock. Okay, so very interesting. Okay, and what I've done to some extent is 16 was probably 4 o'clock. Or yeah, I see what you mean. 16, fair enough. 4 o'clock p.m. So very interesting what different takes are on it. Okay, and I would sort of go quite far to say this is firstly how we often invest as investors, because we have a gut feel on whether the stock market's good or bad. We have a gut feel on whether the property market's good or bad. And really the answer is, and I learned this from Dr. Hunt Australia years ago, is it depends. So when I say to you, you know, where we're at in the property clock, you know, it's far too big an answer to decide, because some areas might be in, you know, different, you've got different geographies, you've got different countries, you've got different cities, you've got different sectors. Okay, so as an investor, we need to start getting clear of like what our strategies are and where we're at. So different sectors are in different cycles of this. You know, retail and office, and I'm going to show you some stuff now, are very much in major, you know, like falling markets. You know, they haven't bottomed out at all yet. Okay, like they're between 1 and 3 o'clock. Tourism, like, doesn't even know what's hit it yet. You know, like it's very much between 1 and 3 o'clock. Industrial properties, you know, there's a whole article here on industrial and how industrial is driven by GDP. And if GDP is decreasing around the world, which it's going to, you know, industrial is probably, you know, still in the 9 to 12 phase, because it hasn't actually, you know, started to have the, you've got with property, you've got what's called a long tail. So the reason you always have oversupply and undersupply is that it takes 2 to 3 years to start a development and to finish a development. So the problem is that when people are all bullish and they get started and they get going, and then the market turns and they're like halfway through their development, they can't change quickly. So that's why in property, the cycles tend to be, the pendulum swings a lot more from one to the other. Caroline said in southern Portugal, we're at 8 o'clock in residential. So, you know, that's exactly it, Caroline, is that different markets are different. So I don't have time tonight or today, depending on what zone you're in, to go through every single sector. Residential is in different sectors, you know, different pricing points, different countries and everything else. But I think for the purposes of what I wanted to share today was that there is a cycle, there is a property clock, and this becomes important. The second article I wanted to share with you is that what you can learn from crashes. So this is another, sorry, let me share the property clock. So I will share this with everyone. How do I, all panelists and attendees. Did I share the last article with all panelists and attendees? Let me just see quickly. No, I didn't. Sorry, I sent it to Lyndon privately. Okay, let me just send it so that you've all got it. Okay, now let's go to the next one. So this gentleman has lived through the last 5 major crashes. He said, what you could learn from Black Monday is don't panic. These recessions, you know, you think it's never going to come to pass, and it actually does. He spoke about the tech wreck and how you must make sure that you don't follow the crowd. You've got to be able to stand out from the crowd. In terms of the Great Recession, you know, this one was interesting that, you know, there were valuations and that actually structural things can change. So as an example, you know, I'm not sure if office space or retail space will ever come back. Just because a building costs $100,000, you know, whatever, it doesn't mean that it'll, you know, it's below market value because it's at 50. It doesn't mean it's going to go back to 100. So a good example of this was 10 years ago, we were buying distressed properties in America, and people were trying to sell properties in Detroit. Now you could buy a highly discounted property because it used to be $100,000 and now you could buy it for $15,000. And everyone was like, it's an amazing deal. But it was absolute rubbish because Detroit fundamentally as a city is broken. 25% of the city is empty. It literally is empty and derelict. The big motor companies are going bankrupt left, right, and center and laying off people. It's called the Rust Belt. And so fundamentally, demand is less than supply. And that's the most important thing in property. If there's more demand, you're in a good place. If there's more supply, you're in a bad place. And so because the properties were $15,000 or $20,000 and they used to be 100, doesn't mean they're going back to 100. So be very careful of a deal you might think you're getting if structurally it's not going to correct. Which is why I shared the article of Francis Verrilli to start off with, because there are technology, environmental, and all the stuff that he spoke about, political, that are going to change the shape of how we operate as humans, commercially, socially, and everything else, and it will impact our property. And then lastly, just under this one, Japan, I don't think is as relevant because he was just talking about what happened in Japan. This article here is the lessons I learned from, sorry, keep forgetting to share these articles. Let me do them while I remember. Okay, the next article, I've only got one more to go. The lessons learned from leaders. So this was really interesting. They interviewed a wide range of leaders in the property industry. And basically it said that what have you learned is that you need to be resilient and nimble. What initiatives have you done to prepare for the downturn? Basically the guy pretty much said, always expect the unexpected. And then what are your plans for the future? And this is the one that I thought was most important, is diversify. Where was it now? I'll share the article with you. Oh yeah, what have you learned? Expect the unexpected. What initiatives are you looking for? It's all about diversification, etc. I'm not going to talk about Ray Dalio because I shared that last month, but Ray Dalio said in April, the number one thing that you should be doing as an investor during these times is to diversify across assets, within assets, across markets, currencies, countries, etc. And I can share that. If you want that Ray Dalio one, ask me and I can share the link as well. The final one I wanted to share, which is now relevant because now we've taken the property clock, is that you can go in and you can actually start to look at which parts of the cycles are doing better and which are doing worse. Okay, so this took into account the rise and fall of real estate values in the UK through the different crashes. Okay, and it actually said that commercial property was a lot worsely affected than residential property. Then what you can see here is the different sectors and how they were impacted based on the GDP. So I think this one's really interesting. So healthcare, okay, primary healthcare, medical, aged care, all of those facilities, okay, is the least affected by changes in GDP. Why? Because if you need a doctor, you go to a doctor, finished. If you need a dentist, you go to a dentist, finished. If you need to move into an old age home, you move into an old age home. Like it's primary healthcare. Residential is the next one. Supermarkets. So this is quite an interesting one because I would challenge that slightly. Residential, that was central, that was outer. Again, today we don't have time to talk about it, but you tend to got, in England, you've got zone 1 to 6 in London, but we've always talked about tier 1, tier 2, and tier 3 parts of the city. And then you can pretty much see here, student housing, etc., secondary healthcare, etc. Now, what I wanted to share with you, I'm not going to share with you all the cities, but what I wanted to share with you was the impact of the GFC. And then basically I wanted to share with you the scenarios that they came down to right at the end, because this is a long article. Where's it gone? Okay, in summary, the immediate impact of the crisis on retail and hotels is clear, with this sector expected to underperform. The longer the crisis continues, the more likely the impact will move to other sectors. As the office sector is most economically sensitive to GDP, office valuations are particularly likely to be under threat. The industrial sector will suffer due to knock-on effects of the recession, but as industrial displays the lowest economic and COVID-19 sensitivity, it will continue to benefit from the rise in e-commerce and particularly greater investment in supply chain resilience. As a result, it is likely to outperform retail and offices under different scenarios. The defensive qualities of alternative sectors like student housing, healthcare, and residential are evident. Indeed, we are likely to see more discrepancy in performance by sector rather than geography. We're entering a cyclical downturn, but cyclical downturns can provide attractive entry points in sectors where there might be short-term dislocation in valuation. So what that basically means is you might be able to pick up good deals. We expect lower quality assets differentiated by the quality of income to underperform and higher quality assets to outperform. This reflects the reduced risk appetite of investors as they focus on secured income strategies, encompassing lower lease, stronger covenants, and buildings that tenants are keen to occupy during recessionary environments. This contrasts with recent times when there was evidence of increased investor risk appetite to boost returns. So I don't want to go any further because I think that sums up perfectly where we're at from a cyclical perspective. Lyndon or anyone else, any comments now? Because I think that explains the cycle. Now we can talk what we're going to try and do and what our partners are doing to provide opportunities based on what to do in these markets.
Yes, Scott, I got no comments. I think it was a very thorough covering of the cycle. Definitely the next step for us in terms of where we're heading and the opportunities coming is what we want to talk about. But let's just double check and see if there aren't any questions that have come through from anyone else. Lee, I'm not sure if there have any questions that come through that you want us to be answering.
We don't have any questions that have come through from our viewers at the moment. I think we've
Scott, I've got
given them, but maybe our wealth consultants have some questions from their clients.
Yeah, sorry for interrupting you there, Lee. I've got that graph that Prof really shared with us on the Urban Land Institute. That's quite an interesting one because that also subdivides it, according to investment grade, development grade, rankings on both, and then also divided by sector and not by geography, exactly what you were saying there. So I can share it with you and you can screen share it a bit later on maybe.
Can you put it in the chat? In the chat
bot?
Yeah.
I'm sure I can. I'll make a plan.
So what I would like to do, thank you for that, Fritz. I think it's very valuable. And you can see the context of what this webinar is about is that, we are looking actively. In fact, we've already done due diligence on a massive company that specializes in student housing. Healthcare, as you know, we've been very strong in both in medical in America, aged care in England, and residential. We've done stuff in residential and continue to do stuff in residential, both multifamily in America. We've done the residential in London recently. So I just wanted to show that actually over the last 12 months even, we've actually been very reticent of the fact that the property clock was changing and that we needed to focus on income. If you've heard me talking, or any of us talking, we've spoken a lot about income and not about capital growth. We've even changed the platform, which I don't know if you're aware of, but when you log in and look at a deal, if I go back to the marketplace, you can actually see here that the cash on cash return, it used to be ROI, which is return on investment, which is the overall return over 5 years. We don't believe that's as important as what is your cash on cash return? What are you going to earn per year in income? So we've even changed the platform to allow it to take place. Fritz has given me that article, and I see there are some questions coming through. So I will, ship it. So this is what you're talking about, Fritz?
Yes, that's the one.
Yeah.
I just shared it in the chat box there.
Great. So this is fascinating. And again, he spoke to this in the last month's webinar, so I'm not going to spend too much time on it. Please listen to that recording. But what they do with the Urban Land Institute every year, as I understand it, is they go and they rank which are the best opportunities, which are the most attractive for investment from a risk perspective. And you can see there that there's a ranking for investment and for development. So what that means is investment is where you buy an existing building, and development is where you go and build a new facility. And you can see logistics facilities is the top of both. Retirement assisted living, better known as aged care, is number 2. Co-living, so we are readapting our project in Australia for co-living. Private rented spaces, student housing, affordable housing, healthcare, number 7, data centers, service departments, flexible services, offices, and co-working. I think you get the point. So Fritz has shared this, the idea is not to talk. And I would love, because this was done in pre-COVID, and as my understanding, Fritz, and I'd love to see how this would change, because I'm sure hotels wouldn't be sitting at 13 right now.
Yeah, I tried to do a bit of research into the Urban Land Institute and get a bit of access, but it's quite a thing getting access there. You have to be a signed up member and all of that. So I'm sure the prof, we might be able to ask the prof next time.
Perfect. So where I wanted to talk about now was that how does one take this into account? So there's a couple of overriding principles that you need to. The first is that you need to look at income producing assets. So we've really been focusing on that. The second is that you need to be diversified across different assets, countries, geographies, currencies, etc. The third is that you need to look to protect your capital. So what that means is that, people are you can see here, are looking for, higher quality assets, lower risk. So that's about protecting your capital. The fourth is that you want to be in asset classes that are defensive to COVID, a slow in the world economy, a slowing in GDP, et cetera, et cetera, et cetera. And finally, from our perspective, what I saw and learned 10 years ago, and some people do or don't know this, but Wealth Migrate was actually built out of frustration, because 10 years ago, there was such a buying opportunity when the property clock went haywire in 2009 after the last crash, that there was an opportunity in London where I could buy 48 units. They were 50% below market value. They were in Wimbledon, which is where the tennis is. They were fully furnished, fully tenanted, and they had a 12% net return, which is just like unheard of in London. I could buy them for £160,000 each. There was just one small little problem. I needed £10 million because I had to buy the entire building, all 48 units. And I didn't have £10 million, and I ran around trying to get investors to work together, and they wouldn't. And we lost the deal. Now today, we would have earned, for the last 10 years, we would earn 12% net every year, which is unbelievable by London and English standards. And those properties have changed in value from, conservatively, they've gone from 160 to at least 600. And maybe on the upside could be closer to 800, 900,000. Now, why is that important? Well, what I learned from the last crash is that by the time the crash happens, it's too late. So if I phone up Fritz and I say, hey, Fritz, do you want to invest in a London deal? And it's an amazing deal, and it's X, Y, and Z, but we're already in the middle of the crash. Fritz is in complete panic mode. And then I phone Siska, and I say, Siska, hey, I got a great deal. You should really get involved. And Siska's in complete panic mode. Like, she's losing her job, and she doesn't know where income's coming from, and her stock market portfolio is down, and she is in complete panic mode. And then I phone Lyndon, and he's like, oh, I might be interested, but I've only got $10, and we need 100 to be able to do the deal. And long story short, 10 years ago, I got nowhere. Okay, so I ran around for the best part of 12 months trying to buy up these incredible assets, and I just couldn't do it because people go into the fear stage of the property clock, and they don't execute. And so what we've been talking about for a long time is that when the market changes, you actually need to pre-fund stuff. Because if I come along to Siska, and I'm just going to use a house because everyone understands how a house works. If Siska has lost her job and she is no longer getting a salary and she can't pay her mortgage, and the bank is looking to foreclose on her and everything else, who do you think is going to get the better deal? Do you think Fritz, who arrives and says, no, don't worry, I like your house, I want to buy it, I'm prepared to offer you, $100,000 for your house, but I need to go get a mortgage, and I need to go and raise a bit of capital to arrange the deposit. So I'll be able to buy it in the next sort of 90 to 120 days. And I won't be 100% certain, but I'd like the deal, and I'd like to sign the deal. Or do you think Siska would sign with Alex? Where if Alex turns up and he's literally got his wallet, I'm going to get my wallet to make it relevant, and he's got his wallet, and his wallet has $100,000 in it, and he puts it on the table and he says, right, I have $100,000 cash here right now. Cisco, you have a challenge. You want to get rid of this property. I can close today. Here's the money. It's here. Proof of deposit, proof of finance, proof of everything in the bank account. Who do you think is going to get the better deal? Who do you think is going to get the better price? And more importantly, who do you think is going to get the deal full stop? I'm interested in what people think. And I'm doing this on purpose to help you engage your brain. Okay, so I can see cash deal. I can see Alex. Anyone else got opinions? Alex, bird in the hand. Okay, so I think, you know, cash talks loudest. Always Fritz, of course. Alex, cash is king, etc., etc. Okay, so I think you get the point. Now, it's no different in commercial property. It's no different in industrial property. Whether the property is $100,000 or $100 million, the same principle stands. So where the opportunity lies is that if we come back to this property clock, is that we are sitting somewhere here. Okay. And do you think the real deals happen between 0 and 3, or between 3 and 6?
Yeah, I would guess between 3 and 6, Scott. Maybe 12 and 3, because people get very scared, I guess, in a falling market. But yeah.
So it's interesting. I'm glad we're getting lots of, and I appreciate all the input from everyone. You're right. It's 3 and 6. So why is this important? Well, because between 0 and 3, COVID's just happened. You know, we're only just starting to realize, the business I'm talking about, we being a business, is just starting to realize, hey, my turnover's down, you know, I can't pay my rents, whatever. And so the cycle takes time. And then after a while, the landlord's like, oh my word, I've now lost half my tenants. I can't pay my mortgage, and, you know, et cetera, et cetera, et cetera. And so it's really, what people tend to do is they make a quick plan or whatever, but when it starts to extend, that's when people get themselves into trouble. And so 3 and 6 is when it happens. So the question is that, you know, anywhere from 9 to 3, you should be preparing for the next buying opportunity. And as Professor Francis Veruli says, any good investor will probably only have 3 or 4 times in their whole life to be able to participate, because it only happens 3 or 4 times in your whole career. On the assumption that you are actively investing for about 40 years, it happens once every 10 years, plus minus. And so on that basis, the way within a cycle is that you've got to not only find assets that tick all the boxes that I've already said, or not that I've said, I've just reiterated what I've shown you in the research, but equally, sometimes you've got to pre-fund, call it a war chest, call it a distressed fund, call it an opportunity fund, call it a vulture fund. I don't really care what you want to call it, but it's where you pre-fund, and then that fund has the ability to actually go and execute and take down deals quickly. And that's the process. Now, the beauty, as I understand it from Gavin and the team, is that that's exactly the system we've built. So as an example, if I'm interested in distressed logistics buildings in Bulgaria, and I'm being facetious on purpose, we could literally put up a thing on the platform and we could say distressed logistics buildings in Bulgaria. And I could take my money in my wallet and I could put it there and I could say, I'm keen on that deal. And we could then say, okay, well, look, we've got $10 million that wants to invest in distressed logistics buildings in Bulgaria, and we could then execute. We could also do it in student. We could also do it in medical. We could also do it in aged care. And that is what we are doing. So to Lyndon's point, and Lyndon, I'm sorry for the long-winded explanation, but hopefully gives better context and value for people, is that when the cycle changes, the strategy has to change and the type of deals has to change. And in property, it takes time for the type of deals to change, which is why we've got so few properties on the platform at the moment, because the cycle changed And now it's time to have the right properties for the stage of the clock or the cycle we're in. And hopefully I've explained enough around the type of strategies people should be doing either on their own or together, and where we as a platform are going to be able to provide for that.
Yeah, thanks, Scott. I think what I want to add there is that in the last probably month, we've turned away certainly north of 10 deals at least that were still being brought to the platform on a pricing from 2 months ago, because that's the length of the deal. And those deals just did not make sense under this current stage in that clock. And what's interesting about that clock for me is that it used to take quite a while for that clock to go from 1 to 2 to 3. It's very rarely that a cycle changes as drastically and as quickly as it has in this particular circumstance. So we really are seeing the speed at which that clock turns at the moment accelerating, at least on the downward trend. I'm not sure, there's a lot of debate as to how quickly it's going to bounce. My personal opinion, and this is not advice, I don't think it's going to bounce that quickly, but I do think in the real estate sector that there is going to be opportunities that come probably in a month or two's time. Is when we'll see the first real distressed assets having been priced right and arriving from sponsors on the Wealth Migrate platform ready to invest. And I think to the point you made, Scott, that's exactly where cash is going to be important. And the sponsors who are going to bring those deals to the platform will need to act quickly to enable that they can secure that opportunity, that deal before someone else who has also got cash is looking to secure the deal. So from our perspective and investors' perspective, really key here, we are trying to encourage investors to build up, to Scott's point, their war chest. So to actually have money in your wallet ready to go. Deal timelines are going to accelerate over the next 3 to 6 months. And what I mean by that is if a deal goes live today, it'll probably close a lot quicker, maybe 2 to 3 weeks time at most, before, if it's a good deal, before that sponsor has raised the funds that they need to go and close the deal, because there are a lot of people building up their cash reserves, not only in Wealth Migrate, but across the real estate sector. So that's really the strategy. It's an exciting time. It's an exciting time. There are going to be coming opportunities in the next month or 2, 3 that are going to be, as Scott says, not that these kind of opportunities don't come very often. We want ourselves and the investors to be prepared to be able to take use of that. So certainly the strategy we would advise is make sure you've got funds in your wallet. As soon as deals start coming through that we believe are priced right in the market, we will certainly be releasing them onto the platform.
Then I think a good example of what you're talking about there is one of our partners with the trophy asset there around the corner of Buckingham Palace, when they were busy vying for that property, and all of the institutions almost fell away, and they didn't have so much competition, being able to pick that asset up for a good price.
And quickly. So just quickly, Lee, I'm very conscious of the time, so I want to wrap up and then go to Q&A, so that if people want to leave on the hour, they've actually got all the answers that they want. So 2 things that I just wanted to point out. One is that Lyndon spoke about clocks, and it's really important to understand economic cycles. And I actually didn't plan today to go into so much economic theory, but as I said to you, economic cycles go in cycles of about 10 years, and the property clock actually breaks down into 2 to 2.5 years on average. So when Lyndon said it's going quicker, it's going a hell of a lot quicker, because we went from 11, 10, 9, 10 or 11 into like 1. It was like we skipped like it just happened extremely quickly. So it's just interesting, but how the cycles work. The last thing I wanted to share with you, and I want to give you a sneak preview, and I'm probably going to get into trouble for doing this, but the point being is that just a window into the future. Oops, sorry, I need the one other thing here. Let me stop sharing. Oh, no, this is actually fine. So let me, where am I going to find that document first? Anyway, so what we've basically been talking about is helping people create a wealth diversification portfolio. And something that we will be bringing out in the next, I know Alex and Fritz and David and the team have been dealing with our investors and talking about it. But equally, you know, I think Fritz, you summed it up perfectly. You know, do people want us to rush something and the product is average and we own an average product for 5 years, or do we want to build a great product and launch it when it's right? You know, in terms of that process. And so, you know, timing is important in markets. And so just to give you an example, this is something that we are looking to bring out in the next couple of weeks. And, you know, the wealth diversification portfolio will be a blend of 4 different opportunities, which I'll talk about now. One of the potential opportunities we're looking at is a medical REIT. So again, it will be to create a war chest to go out and to effectively, they're looking to raise about $50 million from private equity investors, $50 million from institutional. The founder of the company is putting in $10 million themselves, and they are literally going to go so they're going to have $100 million. They're going to go and buy distressed medical buildings, of which 70% of them are going to be existing buildings, 30% of them might be part completion. They're a $13 billion company, 1,300 staff. And once they've built up a portfolio of $100 million, they're then going to list it on the New York Stock Exchange. And us investors, I want to invest in this, will then, when the properties get bundled up into the REIT on the New York Stock Exchange, we'll get a 20% discount on the REIT pricing. So I like it. There's a whole bunch of good stories around that. And that's an opportunity. Now, it's not finalized. We still got that. Funny enough, Lyndon's just sent a message and said he has to leave because he's got a meeting with Intercare in 10 minutes, and that's around aged care, which is really, you know, a very strong. Oh, sorry, this the health one has a 10% cash-on-cash return paid until the assets are purchased, and then once the assets are purchased, a minimum target return of 7% plus. The aged care is 10% in pounds. We've got a fixed income structured note with Credit Suisse as the backing bank, which you might or not have heard of, but I presume you probably have. It's 9% income in pounds. And then lastly, a private equity offering, one which is where there is a cash-on-cash return of 6%, and the other where it's a direct investment in equity where you get all the capital upside but not the income. That is the only product that is not potentially to be included in the WDP product, because there's 3 things we want. We want diversification, we want protection of capital, and we want income. So Lee, for me, that was a sneak preview into the future and how we see, you know, creating that distressed fund to take down assets that are resilient in this market, blending across countries, blending across assets, blending across currencies, and allowing people to participate easily, safely, and simply. And that is where we are going in the month of July, if people want to watch the space. So I'd like to go to questions. There are quite a few questions. Lyndon, you've got to go, or has already gone. Okay. I was going to say, I was going to say if there was anything he wanted to say. Any comments, Lee, from your side before we go into the questions?
No, Scott, none from my side. I think that this has been a very informative session. It definitely took a turn to where we didn't think it was going with all the economics chats that we had, but I think that it has been a fantastic start to our July, delving into what is coming, where we've been, and where the cycle in the real estate markets are at the moment.
Perfect. Siska, can you answer this question for me? Please explain the whole Wealth Migrate versus Allvest wallet and recent email to KYC, as I'm lost with what to do and not to do. Ken.
Sure. Ken, thank you for asking that question. I'm actually the person that sent you that email. So let's just take a step back. In terms of your own portfolio, Ken, obviously you have invested in deals that are currently under management by Allvest. And so you would obviously have a Seychelles wallet, a trading account as such that was opened by PKF Capital. And PKF Capital administers those deals and as well as your actual wallet. So what that means is that all your distributions for your past deals that are now currently with Allvest will go to your Seychelles wallet. Now, one of the reasons why we split from Orbest, or we had a split in 2018, was the mere fact that we identified that our investors would like to diversify their investment portfolio over different levels, country, like Scott mentioned earlier, asset class, and sponsors. So what we have managed to get right is to introduce a global transactional account. With Lemonway, we have integrated a global transactional account, which we obviously refer to as a wallet, on our platform. And what that means is that you are now able to obtain, once you have been KYC verified by them, to obtain this global transactional account, which will then allow you to invest through different deals on our marketplace, under our marketplace, whether it is a deal in the UK, whether it's a deal in the United States, in Orbest deals, and whether we're going to bring new deals to our platform. So you will be able to use your US dollar wallet funds to invest in any of these deals, and it doesn't matter which sponsor brought those deals. So if you wish to remain investing in your medical deals in the United States, then you do not need to come and verify your portfolio with Wealth Migrate. But we are saying that it is something that we are offering you, and we are hoping that you would come and obviously familiarize with our offerings and update your profile, because there are small changes that we had to make. And as an example, Lemonway being the wallet service provider, they ask the country of issue when you upload a copy of your passport. So that was a field that we never requested in the past, but now you need to complete that. So it's very small, minimal changes that you would need to make. But that was the purpose of the email, and just to get you to be verified by them, so that you can obtain that wallet. So in case you wish to go forward to invest in any of our deals, then you can find your wallet and invest. The other benefits of having this wallet is that when you wish to cash out, you will be able to do that by simply clicking on a button, withdraw, and the funds will be wired back directly to your bank account that is associated with your profile on the platform. You do not have to go through a broker dealer like a PKF. You do not have to pay any fees. And when I say that, I'm referring to the fees that Lemonway or Wealth Migrate will charge. We do not charge fees. Lemonway does not charge fees. The only fees that you would occur is obviously through your own banking system, which we don't have control over. So yes, Ken, I hope that answers your question. I'm busy drafting an email just to give you an indication of what we will need should you be interested to complete your KYC.
Brilliant. Thank you, Siska. Just by the way, I've got up a poll. It's just an indicative so that we can understand what you're thinking in terms of the different amounts. And, you know, where we're looking to start, there are going to be additional benefits for investors that invest at a $25,000 level, at a $100,000 level, and $250,000 and above level. So if you are interested, let us know and we can talk through that with you to really make it advantageous for investors. So just let us know what you're thinking, and we can let you know. Also, Lee, if you wouldn't mind just putting in the link to the landing page. It is a sneak preview in terms of where we're going, but sneak preview, put it in there. If you're interested, go look it up, you know, and we can let you know, you know, when it's ready to go. Okay, right. Next question. Garth has asked me, so I'll close out this poll. I'll give everyone 10 more seconds. Those of you who haven't voted to vote. Garth has said, Scott, would you like to know how the Fed's pumping trillions of US into bonds, corporate bonds, you know, has on the property market? I think the most important thing here, Garth, is that it is propping up the market, both residential and commercial. Interest rates have been dropped, and you know, I think what's really important is that it's why everyone's talking about the dollar devaluing and the impact that that would have. Again, I would highly recommend watching the webinar we did with James Painter around that because it's very, very important to understand where currencies are going long term. However, saying that, property is the most resilient asset. It's the best asset to own in a rising inflationary environment. And the reason being because of that is because it's a fixed asset. And, even in Zimbabwe, when the whole economic system fell apart, property is the one thing that retained value in US dollars because people still need a place to live. And if I need a place to work, even if I pay for it with pigs or chickens or Bitcoin, I still found a way to pay for it. So barter. So, but again, America's a big place. I wouldn't say it's all good and it's all bad, Okay. Hi guys. Against the trend of companies allowing employees to work from home and companies downgrading commercial real estate, where do you believe the opportunities are? Also, do you believe that there's a trend like in some countries in the East? Sorry, let me just close this poll. Oh, you have closed it. Thanks, Lee. Do you want to just launch the last poll, Lee, which is just where, we do have people from a private equity perspective that like to be involved directly in our platform. They can see where the world's going. They can see the world's going digital, which I'm now going to answer for Andile. And they say, no, they'd like to be part of Amazon early on to take advantage of a long-term trend. Also, do you believe that there'll be a trend like in some countries in the Far East where the first few floors of office space and higher up residential in the same building? So I think, Andile, there's quite a few questions there. I do think that commercial space is going to take quite a hit. 70% of people have said that they, after COVID, will look at the way they will change their working environments. That came from 500 of the top CEOs in America, Fortune 500 companies. So, I think there's the argument that people need more space when they work at the office. So there's the argument they might need more office space. But I think what will happen is that just less people will be in the office at any one time. And where it's going. In terms of your second question and mixed use, there's absolutely no doubt in my mind that mixed use is where the world is going. And you'll have office, you'll have residential, you'll have entertainment. In South Africa, you've got the example of the V&A waterfront, you've got Melrose Arch, and I think those will become more and more popular within inner circle, co-living, co-working. As we were joking with someone, there's that old saying that's been beaten to death. Called live, work, play. And we've been playing around with that and saying we should have live, work, play, invest. As in you don't just live and work there, but you own a piece of the building as well. Okay, so I can see a number of people have asked for the June recording. I'm glad most of you hadn't seen the property clock, so we've added value to you. Just as a matter of interest, if we've added value today, I'd love to know whether this was worth an hour of your time during your workday. Tourism, as you say, not a good place to be and still no joy. Yeah, I hear you, Peter. Challenges no one knows where to from here. Boom, boom, boom. I'm just trying to jump through them. Ray Dalio, okay, I'll find Ray Dalio and put it up now when we do the questions. Need more info in terms of the survey. If you need more info or you'd like more info, just let us know and we'll let you know. We're going to run some webinars over the next 2 weeks around that. Once I've done the sign up and done the due diligence, where do I put my $100? Peter, you get to decide. You decide what property you want to invest in. Would logistics facilities, including warehousing? So I think I've answered that, Garth, in terms of the research that I've shown you. My concerns are with Cypress Ridge, our first investment, and it has not been a great one. Multifamily was punted for a few years and was not so popular. Are you still doing multifamily? Yes, Caroline, I think multifamily is a very good investment class. Unfortunately, Cyprus has not gone according to plan. And we're working very proactively on it. My question, Caroline, is are you on the WhatsApp group, the Cyprus WhatsApp group? I'm actively working with the investors at the moment to create what we call a project committee, which is the way we solve projects if they're not going according to plan and get them back on track. So I think it's very important that that project is resolved. And just for all the other investors, if you think that every deal on our platform forever and a day is going to work, it won't. If I said it would, I'd be lying or cheating you. And the reason being is that property investment business doesn't all work. But that's why we've got diversification. That's why what Siska mentioned with a global digital wallet makes life so much easier, because you can invest in different wallets. Sorry, not different wallets, different assets. And you know, if you've got $100,000 and you put $10,000 into 10 deals, and 9 of them work and 1 of them doesn't, then you know you've got yourself protected. My sense is e-commerce is going to rally, and sure, warehousing will be growing. Agreed. So I agree with logistics and warehousing. That's all around warehousing. Scott, will medical still be a good option? People do not visit doctors' rooms only if absolutely necessary. Will these medical tenants also be under severe stress? So Adele, good question. You know, even based on the research of what we've experienced, you know, in terms of one of our partners, Allvest, with their entire portfolio, they've got 94% of the tenants are paying at the moment. And what tends to happen is it tends to be like dentists and chiropractors and stuff that aren't paying because they weren't allowed to open during the COVID epidemic. But you know what's interesting is that if you've got a toothache and there's no dentist open, the moment they open, you're going to go see them. So you know, it's fairly economically resilient. Whereas a restaurant, if it closes down, you know, might never open again. Will there be a euro or sterling wallet in the future? Gavin, I don't know if you want to speak to that. I know that we've certainly got the functionality to be able to do it, but it's a timing thing.
Yeah, absolutely. So will there be one in the future? The odds are pretty good on that. I can't give you an exact timing on when. There are certain complications with that we do need to work out, mainly around the customer experience of it. It gets slightly more tricky than just having a new wallet. It's how you're able to interact with the deals seamlessly and smoothly.
Ken of Anger, I appreciate your comment, and you know, my suggestion is that whoever is your wealth consultant, I don't know, Fritz or Alex or David, if you can you know, reach out to Ken. There is a way, Ken, to, if you've got your money in wallets in the Seychelles with Allvest, how you can move all your money over to your digital wallet in Lemonway and then invest everything through Wealth Migrate. Even if you want to invest in Allvest, no problem. You can invest, you know, directly in an Allvest deal, but through the global system, through the global wallets, etc. So we have done that.
Scott, that's a very interesting way of pronouncing Ken's surname. Definitely a very English way of saying it.
Fair enough. I am from Durban, and my mom was from Kenya and my dad was from Zimbabwe. So the chances of too much Afrikaans in my family, if that's what you're trying to say, was quite small. Okay, checked. Okay, so Ken, one of our team will get back to you. And Siska's answered it, but one of our team will get back to you. It's a pleasure. I have sent an additional 800 to the new Wealth Migrate wallet system on June the 23rd, but still cannot see the deposit on my Wealth Migrate account. Is this normal that deposits are so low? Normal that deposits are so low? I thought that the transfer should be quite fast because I have sent funds from my BNP Paribas account. I don't know, Gavin, if you want to talk to that. I know it's different from all different banks. I send money from my Lloyd's account in England, and it took about a week or so. But unfortunately, we can only control what happens when it arrives in Lemonway. We can't control the interbanking side.
Yeah, so Siska will follow up with him. What is most likely happening is the fact that it was euro that was sent, but we'll follow up with Patrick specifically on that.
Lee, you didn't, you put here, there's a link to the sneak preview of the wealth diversification portfolio, but didn't have a link.
No, I did further down.
Oh,
I
okay.
corrected my mistake. Sorry, everybody.
Okay, Rob, thank you for the nice comments. Thanks for all the nice comments from everyone. No link, okay, there it is. Great. Perfect. So I think I've answered all the comments in the chat box. On the Q&A, and I don't quite know what the difference is, but on the Q&A, any comments on Chinese or Australian opportunities? So Chinese opportunities, I'm trying to push our Australian team to start to find opportunities. They've tended to help people invest from China outside. So at the moment, the only opportunity we've got is a private equity opportunity to invest in a Chinese company, a high growth tech company, which is the Wealth Migrate equivalent in China. And Australia, the team there is looking, but the Australian market has been very overpriced for the last year or two. And now we're starting to talk about distressed opportunities. In fact, we had a talk just this morning. So once we can find something there, we will look to certainly bring it. Will there be investments with 1,000 minimum required opening in the near future? So what's quite interesting with the Wealth Diversified portfolio, and just to start managing expectations, it is going to be more of a sophisticated investment, and the minimums will be probably closer to $25,000. We will, as our commitment within Wealth Migrate, if you have funded your wallets and you've got wallets like I do and others where you've got dividends and wallets, etc., Lee will be finding a way to communicate with people. We won't be putting it out publicly, but we will be finding a way for people to participate in deals from smaller amounts. So our commitment is to look after our investors, but we're not going to go out and publicly saying you can invest in these deals from this amount. So my suggestion is be part of the platform and we'll keep you updated. Hi, Scott. What do you believe is a reasonable time frame for prime rates in SA to stay low to buy a res property? Anonymous, interesting question. I am not an economist, and so I'm now sort of talking out of turn. South Africa is in a very complex situation, and you know, Ken Williams speaks much more eloquently about this with our Twin Peaks deficit and the bigger problems we've got. Because on the one side of things, you've got interest rates, which they want to hold low to try and stimulate growth in the economy because South Africa's in such problems like all the other countries are around the world. But on the other side of the problem, we've now gone to junk status, and you know, we need to basically increase interest rates to attract foreign direct investment. And by attracting foreign direct investment, you start to stimulate the economy. I don't know if you can see the dichotomy. You keep interest rates low to try and stimulate the economy, or you put interest rates up to try and stimulate the economy. And at the moment, they've gone for the interest rates low part to stimulate the economy, primarily because inflation's low and oil prices have been low. And so I think there's quite a few things there that are there's a lot of moving parts there in terms of that question. Where's it gone now? Sorry,
Scott, if I can just add a point there, just something that I know is that, and I discussed this, or I asked this to Francois Viruli, the prof, on our webinar as well, is that when countries actually implement these stimulus packages and they decrease the interest rates and things like that, for quite a period of time afterwards, it might be a quarter or even more than that, the financing actually doesn't go the way that you think it would, according to stimulating the economy. It actually dries up for a while. I specifically asked this to the prof as well, and the reasoning behind this, according to him, is the fact that the financiers are actually the suppliers of finance across the economy are running higher risks directly following a economic sort of restructure or shock, such as COVID-19, because obviously you have a lot of, you know, say everyday people, for instance, you know, that their jobs might not be as certain as they think it is. The banks have to rebalance their credit scores and things like that. So there is a period where stimulus actually doesn't work for a while after it's been implemented, and only then it becomes practical in the economy, and it ciphers down to the end users. So yeah, from my perspective, I don't see the Reserve Bank actually letting that up for quite a while still. Otherwise, they'll just be wasting their own time, and the stimulus wouldn't have been effective ever.
Yeah, I think the last point, I'd look at it from another side. One of the guys that I learned from right in the beginning was Dr. Hannes Dreyer, and I like the way he operated. Was don't go and buy a property based on your cost of capital being 8, 9, or 10%, because the chances are it's going to go up. And if you own a property for 20 years, I guarantee you that in the next 20 years, it's going to go up at some point in those 20 years. So what's much more important is to the long-term cost of capital is sitting probably in South African terms somewhere between 12 to 14%. And so you should be stress testing your models based on 12 to 14%, and even stress testing it, if you, depending on how risk averse you are, going to sort of 16 to 18%. Now, will it ever go to 16 to 18%? Don't know. But what my uncle taught me when it came to risk was figure out what your worst case scenario is. And if you can survive that, then everything else is upside. So I would look at it from both sides. And unfortunately, coming back to the property clock, that's why people get so burnt, because they, interest rates go down, they buy, interest rates in England are the lowest they've been since the Bank of England was created 350 years ago. They buy a property, they're first-time homeowner, it's like just can afford it, and then interest rates go up 0.5% and they fall over, and that's it's just something to be so aware of. Lee, I think we've pretty much covered it. The one question was around Peniel House, the aged care. Yes, it has closed, and that's actually why Lyndon had to leave, because he's got a due diligence meeting on the next project. And I think we've actually answered all the questions. What is the time there? We're pretty much on the 90 minutes, which is on or when we want to, complete. Happy to stay on as long as needed if anyone's got any further questions. But yeah, that's all from my side, Lee. Just to remind everyone that tonight I'm going to be talking about goals and, more importantly, tracking. And if you're on track, great. If you're off track, what do you do about it? And if you've got no idea, that's the most important part, start tracking.
Absolutely. Thanks, Scott, and thanks to all the panelists that have been online with us. And of course, to you, our community, for joining us this afternoon and spending the last hour and a half with us. We really do appreciate your time, and we are so grateful that so many of you found it valuable with the information that we shared. I'm sure that you all have been introduced to your wealth consultants, so please reach out to them. If you have any questions, you're welcome to reach out to me as well on leerush@wealthmigrate.com. We look forward to sharing with you tonight. That's 5 p.m. GMT, 6 p.m. UK, and 7 p.m. South African time, where we will get Scott into the hot seat, where he does a review of his personal goals that he set and takes us through the process of how you can track them. So we look forward to it. Thanks very much. Please enjoy the rest of your afternoon, and we look forward to seeing you online tonight. Take care, everybody.
And Lee, we put all the links up if people want links or want to find people or anything like that, And please, if you're interested in what we bring out with the wealth diversification portfolio, reach out to one of the team members. Take a look at the landing page we put together, which is a teaser. Read the information and talk to one of us. Set an appointment and talk to us. It is going to be a more sophisticated approach, and we want people to understand what they're getting involved in.
Thanks, Scott. Goodbye, everybody. Take care.
Thanks, Ron.
Cheers all.
Cheers.